Hello everyone, welcome back. We are going to continue with the general partner investor perspective in the investment process. This is the second part of this section, and we are going to go through this in two parts. Firstly, we'll focus on the calculations and interpretation of private fund management performance, and then we'll end up by looking at the sources of value creation in private markets. This is going to be a rather long session, so I want you guys to bear with me as we go through this stuff. Whenever you feel tired, pause, get a cup of coffee, a glass of water, and come back and continue. Let's get right into this. Remember, we spoke about the hurdle rates, and we said with the hurdle rate, what happens is that the fees, performance fees, are going to be given to the GPs if they exceed a certain amount. So suppose the hurdle rate was 270, and then the performance of this fund, they make a profit of 360. The profit is only on the 360 minus 270 by how much they've exceeded this, and then they multiply this by the return fees for the general partner. All right, so this is only on returns that exceed the hurdle, and it works well when the returns are steady or when fees are paid at the fund's end. So it works well when the fees are being paid at the fund's end. On the other hand, the soft hurdle rate is paid on the entire return. So unlike in this instance where you have just the profits above the hurdle, you take the entire profit. If it's a soft return, if the profit is 360, it has to exceed 270, right? You need to get the profit that exceeds 270. Once you exceed this 270, you get the percentage of the entire return. So the percentage for the general partner is on the 360. That's the difference here. So here it's only the percentage on what is above the hurdle, but here it's the percentage on all of the entire return. There is what they refer to as a catch-up clause, and this ensures that the compensation catches up after exceeding the hurdle. So if the hurdle is exceeded, the payment given to the general partners should catch up and meet the percentage that is demanded beyond the hurdle rate. So with the catch-up clause, the GPs earn 100% of distributions until return reaches the GP-LP split. The GP-LP split is the percentage that you get. Like your GPs, if the GPs are getting P, it means the LPs are getting 1 minus P, because it has to add up to 100. So if this is 0.1, it means the LPs will get 90%. Hence, the performance with the catch-up is the maximum of these two. Either 0, which means they failed to reach the hurdle rate. But if they exceed the hurdle rate, the return they get has to be the catch-up, the public fund, the private performance fee, and then the return on the fund, the hurdle rate, and the catch-up. So you have the catch-up here. On the catch-up rate, you then add this entire return, where you have the fund return, you subtract the hurdle, you subtract the catch-up, you multiply by the performance, the GP performance fee on the total return. Okay. Now let's quickly look at this example. You have Bardstown partners, and they are reviewing their fund policy on carried interest. Initially, they had an 8% hurdle rate with a carried interest of 20%. We have done this. But now they are considering changing their terms to include a soft hurdle rate of 9% and a carried interest percentage of 10%. Okay. Now, the fund is still 300 million. They've generated again 360 million over a 10-year life. So you have to discuss how the proposed new carried policy compares to the original carried policy interest approach using a hard hurdle rate. All right. Now, with this soft rate of 9%, the soft hurdle rate is equals to 9%. And this is over 10 years. We assume that there is no compounding. So the amount with the soft hurdle rate is equals to 9% for 10 years and 300 million, which is the fund size. If you multiply this, you should get 270. And we see that here the fund is already exceeded because they made a profit of 360. You see, so the profit for the fund has exceeded the soft hurdle rate because the profit is 360, the hurdle rate is 270. And now, if you are using the soft hurdle rate of 9%, the carried interest is simply going to be 10%. And remember this, it is going to be on the total return. The 10% is going to be on the total return, which means you have your 360, that is the total return, and you multiply this by the carried interest percentage, which is 10%, and then you get a total amount of 36 million. So this is very simple, quite straightforward. Alternatively, you can look at it this way. Once they exceed 270, right, to get to the amount invested, which is 300, they are going to be given a catch-up percentage of 10% to get to 300, which means it's going to be 300 minus 270, and then they get 30 million to catch up. Okay, and then after they catch up, there's another 60 million that is made, and this extra 60 million is going to be divided with this split policy. You see, the 10% is going to the GPs, so it's the 10% 90% split. Hence, your GPs are going to get 10% of 60, which is 0.1 times 60 million, and it's 6 million, right? Plus the amount they were paid to catch up with the 10%. So the total amount that they get would then be the 30 with the catch up plus the 10-90 split 6, which is 36 million, the same as this amount here. Okay, so you can either calculate it this way or you can calculate it this way. It should give you the same answer. This is very straightforward here. Then the second part is discuss the potential downside risk to Bardstown of changing its carried interest compensation structure from the hard hurdle of 8% and the carried interest rate of 20% to a higher soft hurdle rate and a lower carried interest. All right. So what happens is, if you are going to reduce the hurdle rate, right? This is with the soft hurdle rate, you have a lower carried interest, even though you are getting a percentage of the total return. But the risk to doing this is that you forego any upside potential if fund does really well. So if the fund performs very well, you are going to have to forego the upside potential of this fund. For instance, for every 50 million, let's say there's an additional 50 million in profit, right? If you take the percentage of 20%, okay, if the percentage is 20%, for every 50 million that you get, you are going to get a carried interest of 20% of 50 million. Okay, and then 20% of 50, let me just quickly do this, which is 10. So you get 10 million for every extra 50 million. But if you have a lower performance fee of 10%, this is easier, you only get 5 million, which is lower. All right, and therefore you get less. That's the risk that Bardstown is going to incur in terms of the upside potential of the fund. Okay, so just looking at the soft and hard hardware rates, we spoke about this, right? But the soft hardware rate, it ensures carried interest approximates the ultimate share of total funds for the GPs once the hardware has been cleared, right? The soft hardware rate is beneficial if the performance of the fund fluctuates. So this is beneficial if the performance fluctuates. There are fee limiting strategies for LPs. So LPs, obviously, they've invested. They want to make the best out of their decision to invest. And hence, they have strategies that they can use. They can negotiate these fee limiting strategies. Number one, they can put a high watermark. And what the high watermark does is that it prevents the general partner from earning fees on the same profit twice in case the fund value declines and then recovers. Okay, so if the value of the fund goes up, they earn a certain amount. Let's say the fund is here, and then it goes here. Right? So they are going to earn a profit, this amount as profit. If the fund then decreases, it goes down beyond this, and then it starts to recover again to this. As long as it has not reached its previous peak here, they cannot be paid because they will be getting paid twice. It has to exceed the previous high, which is what they refer to as the high water mark. Okay, so this, it has to go beyond this for them to be paid another performance fee. As long as it doesn't go beyond this, there's no payment of another performance fee. So it therefore ensures that GPs cannot charge performance fees unless it exceeds the previous peak. And this is usually used in hedge funds or in investment vehicles that are marked to market, which means the value of the fund is continuously evaluated on a daily basis. And then the clawback provisions, these are GPs, they have to return the general partners. Let's say they've been given a lot of money for performance in an asset, but then the asset starts to underperform in subsequent years. They have to return. If they have weaker returns in the future, they have to return part of their performance fees because they are now underperforming. That's the clawback provision. You understand it better in an example just now. So let's look at this. I want you to pause this, read this, and then we'll go through it together. I just want to avoid reading everything. Just pause, read through this. I'll quickly try and read it. Tyndallage Investment Fund 8 has successfully exited its 100 million private fund investments after 7 years. The fund made one investment per year at the beginning of each of the first 4 years and exited each investment 4 years after capital deployment. The following table provides a summary of the fund's committed capital, capital deployment, cost basis of exited investments, and cash inflows by year over the fund's life. Tyndallage assessed the fees. So the management fees are 2% of committed capital during the period of which the fund deployed capital, 1 to 3 years, and then 2% of committed capital less the cumulative cost basis of exited investments following the capital deployment phase. The first question is, calculate the fund management fees over the 7 years. You are told that for the first 3 years, it's 2% of the committed capital. So it's simply 2% of the committed capital of 100. 2% of 100 is 2. And that is the same for the first 3 years, from years 1 to years 3. So this is 2 and this is 2. When you get to year number 4, read this carefully. 2% of committed capital minus the cumulative. So it's 2% of this committed capital minus cumulative cost basis of exited investments following capital deployment phase. So you take the committed capital, you subtract cumulative cost basis from years 4 to 7. So let's go to year number 4. The committed capital is the same for all the years, right? But then you have to subtract the cumulative cost basis of exited. Then if you go up, cost basis of exits, here we get 20. So it's 100 minus 20, and then you get 2% of this. So 2% of 80 is 1,6. Then you come here, 100 minus, it's a cumulative now, because we have 20 here, and then now we have 40 here. If you add these two, it's 60. So it's going to be 100 minus 60, and then you calculate the 2% of this. So the 2% of this is going to be 0,8. You do the same here. 100 minus, it's now 60, and then plus your 30 here, you get 90. If you add this 30 here, you're going to get 90. All right. So it's minus 90, and then you want to get 2% of 10. 2% of 10 is equals to 0,2. Then the final one, if you add 90 plus this 10, at the end it's 100. So it's 100 here, 100 minus 100, and you want 2% of that. You get 0. You add this 2 plus 2 plus 2 plus 1,6 plus 0,8 plus 0,2 plus 0. So the total of fees, once you put these numbers in your calculator, is equals to 2 plus 2 plus 2, 6 plus 1,8 plus 0,8 plus 0,2, 8,6 million. So the total management fees over the 7 years is going to be 8.6 million. That's how you do that. Okay, number 2, construct the fund's internal rate of return, growth of management fees. So once you see this internal rate of return, this is something you know you have to do using your financial calculator. But first you need to determine what the cash flows are. And the cash flows are given down here. These are the net cash flows. You can see them. I put this here, which was an extract from the question, so that we can just take these cash flows down here. You don't get confused to where we got the numbers. So the cash flow is in the first year, it's minus 20, minus 35, minus 35, minus 17, 6, 43, 50, 44, 20. And then you put this in your calculator. You should know how to do this by now. If you don't know, just let me know. We can do them together. But this, you put this as cash flow 0, you put this as cash flow 1, cash flow 2, cash flow 3, cash flow 4, cash flow 5, cash flow 6, cash flow 7. And then you compute your internal rate of return. Then once you compute your internal rate of return for these cash flows, right, the internal rate of return for the net cash flows before fees, the IRR should be 21.7%. Okay, so they say this internal rate of return is gross of management fees. Now, if you take into account the management fees which you obtained previously, remember our management fees for the first year. So in this initial year 0, there's no management fee here, it's minus 20. But for the first year, year number 1, it was 2. So you subtract 2 here, and you get minus 37, which was 2% of our investment, 100 million, it was 2. And then 2% here, we subtract 2 here, we have minus 19. We subtract 2 here, we get 4. And then it went to 1.6. So we just say 43 minus 1.6 is 41,4. 50 minus 1.6, 49,2. no, this was 0.8, and then this was 0.2. You subtract 0.2, you should get 43.8, and then finally the fee here was equals to 0, and hence we subtract 0, we get 20. If you put this into your calculator, the internal rate of return net of management fees, the internal rate of return, now you've subtracted management fees, so it's net management fees. You compute this from your calculator, cash flow 0, 1, 2, 3, 4, 5, 6, 7. You should get the internal rate of return equal to 19.2%. So put these numbers in your calculator and just make sure you get these numbers. I've done them and I know this is correct. This is correct. And what you see is that if the payment of the management fees is paid across all these years, from here where it's 2, 1.6, 0.8, 0.20, if they pay this, what you realize is that the internal rate of return is going to be approximately, there's a difference of 250 basis points, 21.7% minus 19.2%, you're going to get 2.5%, which is the same as saying 250 basis points. So we are basically saying that the payment of 8.6 million fees spread over the time reduces the estimated rate of return for the limited partners by approximately 250 basis points. Okay. Question number 3. You've been asked to estimate the carried interest received by Tenderledge and discuss the relative size of these performance fees as compared to management fees in terms of its effect on fund performance. All right. So I've put this again because we want to estimate the carried interest. We have these cash flows. The return is going to be based on these additional cash flows and also the cost basis. Hence, the fund's return we're going to get the fund's return, no compounding. Is going to be given by the yearly cash flows plus the return on exited investments minus the original capital. That gives you the total amount of money that you would have. So if you look at these cash flows are here, 0, 5, 13, 16. You add these amounts. Let's just quickly add this. So this is 18. 18 plus 16. 34. Let me just put this number here so that you have 34. And then you add this now, where you have 23 plus 20. 43. 40 plus 20, because you're adding the return from exited investments. This is 50. Then 30 plus 14, it's 44. And then 10 plus 10, it's 20. Then you subtract the initial investment of 100. If you do this without compounding, the return for the fund is going to be 91. Okay. This is the return. And then the return after management fees, after you take into account the management fees, this is equals to 91. Remember, we calculated our management fees previously as 8.6. So you subtract 8.6 and then you get a return of 82.4 million. And then we are told that the hurdle rate is 8%. If you go back, I think I should have put it somewhere here, but the hurdle rate is given as 8%. without any compounding. And then to calculate the amount and also what is mentioned pertaining to the, let me just go back there so that you guys understand what I'm talking about. Okay, here is 20%, that's the return net management fees over an 8% hurdle rate payable at the end of the fund's life. So this is payable at the end of the fund's life. Important. The annual hurdle rate is applied to individual investments so that the total hurdle rate is based on 4-year investment horizon. So the investment horizon is 4 years. These are the important things to take note of. The 20% return on management fees, your P, the hurdle rate of 8%, payable at, so this is over in 8%. So this is a hurdle rate. And the annual is applied to individual investment total hurdle based on 4 years. So the investment horizon is 4 years. These are the things I wanted you guys to take into account. So let's go back here. It's 8% of the invested amount over 4 years. So it's 8% of 100 million times 4 years. To calculate this, you must get, if you get, it's 8 times 4, which is 32 million. And we see that our profit already has exceeded this. This is our profit, which is more than the hurdle rate of 32 million. And therefore, the performance fee, you remember the formula was this, the GP performance fee was the maximum of either 0 if this was less, but because we have exceeded the performance fee, the return is higher than the hurdle rate, we take the GP fees of 20% multiplied by 82, because it's a hurdle rate, it's over the amount, 84 minus 32. Then if you calculate this is a positive, this is 20%. If you calculate this, the performance fees are going to be 10.08 million for the GP. Okay, and then based on these cash flows, remember they said also, when I read through, if you can go back to that, if you read through, it says the fees are paid at the end here. They are paid at the end, which means on this 20 you subtract 10.8. If you subtract 10.8, you are going to get 9.92. So all your cash flows, your cash flow 0 is still the same, cash flow 1 is still the same, cash flow 2 the same, cash flow 3 the same, cash flow 4 the same, cash flow 5 the same, cash flow 6 the same. The only cash flow that changes is this one. This is cash flow 7. It's now 9.92. You have subtracted the fees. If you do this and you calculate the IRR, the internal rate of return, you use your calculator by inserting these cash flows and computing the IRR, you're going to get 17.83%. Okay, so which means the return to the LP, again, because of the payment of this at the end of this period, is going to reduce the return to the limited partners by 140 basis points. I'm going to reduce this by, I mean, check this for yourself, but you will see this reduction of 140 basis points. Question number 4. Estimate the revised carried interest received by Tenderledge if we change our assumption to a soft. We remember we had a hard hurdle rate. The soft hurdle rate is very simple, straightforward. 10% in the carried interest of 15%. This is the payment to the fund managers, the GPs, and discuss the revised carried interest amount relative to the estimate. Right? So, like I said, it's straightforward. The hurdle rate now, it's 10%. It's a soft hurdle rate, which is 10%. And this 10% our investment horizon is 4 years, and it's 100 million invested. So this is going to be 40 million. That's our hurdle rate. But our investment net, the management fees, we got that the profit for the fund was equal to 82.4, which is greater than the 40 million for the soft hurdle rate, which therefore means we are going to get on the total return, we get 15%. So it's on total return. So it's 82.4. So the GP, the return to the GP is 82.4 times 0.15. You put this into your calculator, you should get 12.36 million. All right. So just to make sure you can do this, this is quite straightforward. Alternatively, what you could do, you are going to consider the catch up. You're going to consider the catch up, the hurdle rate, like we said. So this is alternatively the hurdle rate. If we use the hurdle rate, the hurdle is going to be, it's 40 million. Okay, this is going to be 40 million. Our return is 15. Okay, and we are going to calculate a percentage, the 15%, to get to this 40 million. You want to get to a certain amount whereby if you multiply this amount by 1 minus 15%, you should get 40. That's what you're basically saying, that there should be an interest of this carried interest of 15%. So the amount you get to this X has to be 40 over 0.85, and this gives you 47.06 million. What this means is that to get to the hurdle rate, after the hurdle rate has been exceeded, to catch up, this 15% is paid. The 15% paid means that the GP fees are going to be equal to 7.06, right? The GP fees are going to be 7.06, and then beyond this 15%, the catch up. So this is the catch up. Beyond this catch up, you have to reach a profit of 82.4, and this difference now is going to be paid using the 15%. So it's going to be a 15%, 85% split after the catch up. So after the catch up, we are going to have the profit of 82.4 minus the 47 we calculated there, 0.06, multiplied by 15%. Then if you calculate this, you're going to get 5.3. Okay, 5.3 million. And then, which therefore implies that the total is this 5.3 plus the initial 7.06. Then the total is equal to 12.36 million, which is the same as we calculated here. This is the quickest way to do this, but also you might be required to just calculate the catch-up amount, and this is how you do it to get the catch-up amount. 7.06, it's just beyond the 40 million hurdle. The 40 million hurdle, yeah. Okay. And then let's quickly go through another case study, which is not going to take us as much time. You have an Estragon SA, a French venture capital fund manager, recently exited its latest 100 million fund after 7 years. The fund consisted of 4 investments, 25 million made at the beginning of the first 4 years of the fund's life. At the beginning of year 4, Estrogen exited its first investment, selling its stake for 200 million. Unfortunately, Estrogen's subsequent 3 investments all failed, so 0. Which is where now the catch-up clause is going to, the clawback provision would come into effect. Okay, no, not catch-up, my mistake. Okay, Estrogen's LPs negotiated a clawback provision in the limited partnership agreement that total carried interest over the life of the fund could not exceed 20% of the returns over the hurdle of 105. Okay, so discuss how Estrogen's LPs benefited from the inclusion of, how did the investors benefit from the inclusion of this clawback provision. Now we have 100 million that was invested, and Estrogen exited by selling its stake for 200 million, right? The returns have a hurdle amount of 60. This is the hurdle amount. Okay. And because of this hurdle amount, they want returns in excess of, which means it's a hard hurdle rate. So they made 200 million. Okay. They made 200 million, and which exceeds the hurdle of 60. So you subtract 60. And then to get their return, you multiply by the money that is given. The Estragon collected a carried interest charge of 20%. You multiply this by 20%. And then you're going to get 28 million. Okay, you're going to get 28 million euros. So, but in subsequent years now, the return for the next year is nothing, zero, zero, zero. There's no return. All the return was made in the initial year. Okay. What this therefore means, if you look at the last part, Estragon's LPs negotiated a clawback provision in the limited partnership agreement that total carried interest over the life of the fund could not exceed 20% of returns over a hurdle of 105. So they can't exceed over a hurdle. This is the clawback provision now, where a clawback, it cannot be, it has to be the GP return has to be less than or equal to, it must not exceed this, so it must be 200 minus 105 multiplied by their percentage fee, the carried interest, 20%. So the GP return must be less than or equal to, if you calculate this, it must give you 19. It must be 19. But you see that earlier they were given 28 million. They can't get more than 19, which means they have to, if they are getting 19, they have to pay back part of this 28. They pay back part of this 28. And this payback amount is equals to 9. So this 9 is paid back to LPs, the investors, the limited partners. And hence limited partners benefit by getting a back payment because of an underperforming fund for like 3 years. Okay, so that's the benefit they get in that instance. Note states it's another case study. Note state a large US state pension fund commits 50 million to Bardstown Partners' latest buyout equity. buyout equity fund with a term of 10 years. Based on its experience in private equity investing, North States believes that its capital will not be called for 2 years. During this period, North States invest in a public equity index. Northern States expects compound annual private equity returns of 16% and public equity of 10%, while US Treasury securities are expected to return 5%. Okay, so it's Northern States. Let's discuss the extent to which Northern States' expectations of investment perform over 10 years may differ from the forecast private equity expectations of 16%. So just quickly going through this, right? Don't want to take too much time on this. But basically, what is going to happen is that they are going to call the amount in 2 years. This is what the expectation is, right? Based on their experience, Northern States believes that the capital will not be called for 2 years. And as we discussed earlier in the first section, is that usually they invest this money in a liquid public asset so that it gets some return to mitigate any opportunity cost of just keeping the money without any investment. All right. So if they are going to invest this amount of money, if they invest this money and they get a return of 10%, so the public equity gives a return of 10%, this is for the first 2 years. And then the remaining 8 years, remember the total amount of time is 10 years, right? And what you're going to do is the public, the first, before the capital is deployed, committed capital, let's call the period N1 before deployment. And then after deployment, it's just the total N years minus N1. Okay. So the return, the compounded return in this instance, you're going to take the interest from this public market return, and then you raise it to the power of n. Then you multiply by the interest in the private market return. Then it's n minus the small n to the power of 1 over n minus 1. In this case, 10% is for the public market, so it's 1,1 to the power of, it's only 2 years. It's only 2 years to the power of 2 multiplied by 16%, 1,16, which is 10 minus 2, it's 8, to the power of 1 over 10, it's a total of 10 years minus 1. Calculate this, we're going to get a return of 14.8%. Okay, you're going to get it, which is a bit lower than 16% by how many? 120 basis points. So obviously there's lower returns in the public market. Discuss how Northern States might address the shortfall risk associated with the capital commitment. So to address this shortfall risk, what they can do is that they invest in public markets. Public markets are less risky. They are more liquid and less risky. Okay, because there's less uncertainty in public markets, and this already has been highlighted in the strategy that they've used here. That's what they did by investing in the public market index. Okay, so from an LP perspective, the ability to benchmark and adequately diversify private portfolios is considered when evaluating the performance from an LP perspective. And this is tough in private markets because private markets, there's a lot of issues in terms of illiquidity and benchmarking in terms of similar assets, similar vintage years, similar management styles in terms of GP. So it's quite difficult. The public equity fund investors, they have a wide array of investable index-based alternatives. That's not the case for private markets. So private market limited partners, they face several barriers in matching the aggregate reported returns for a particular private asset class. Number one, the need to hold liquid investments for committed capital that is not yet deployed creates a drag on returns. So they have to keep money in liquid form, or they get assets that are highly liquid so that they get some return, but it's not as high as investments in the private assets themselves. So they have to hold liquid assets that they've committed so that they are deployed when wanted. Okay, and then an investor's ability to diversify across specific GPs, high dispersion of realized returns often exists between the top and bottom quartiles of performance for private asset classes. So it's very difficult to diversify in terms of general partners, and also because of illiquidity and limited secondary markets, vintage year diversification is also very difficult for limited partners. So these are some of the challenges that they face, having to hold committed capital, not having access to different types of GPs across different private asset classes, and also being difficult to diversify across different vintage years because the secondary markets are limited. There's high levels of illiquidity in private markets. All right, so this question shouldn't also take us a lot of time. These questions, like I always suggest, you pause and then you come back, you do it. First question, discuss 2 reasons why private market investment fund managers' fees are typically paid to GPs by LPs based on committed capital as opposed to invested capital. Okay. So the first thing is, one, these GPs, they do a lot of work. GPs work during the pre-commitment stage. Most of what they do is due diligence. This is very crucial, and they have to be paid for this part of their work. They do prior in the pre-commitment stage, they do some prior work in terms of due diligence. Okay, and then number 2, when they are paying according to the committed capital, what it means is that these GPs do not misuse money. So they have to keep this money until they find assets that are lucrative or investment that are lucrative, and then they invest in those lucrative. So they are not too quick to deploy the money that they are given on less attractive investments so that they generate management fees. They are careful with the money, and they do work in terms of pre-commitment in establishing the investment thesis, which we spoke about earlier. Number 2, which of the following fund returns and carried interest structures is most likely to generate the highest amount of performance fees for a GP? So the first one is a hard hurdle rate, and remember, the hard hurdle rate is over and above this hurdle rate. So basically for A, let me do this. Let's say for A here, you want to get the maximum of 0, and the return to the manager after fees is 20%, and you have the carried interest of 20%. Okay, you have a carried interest of 20%, the hurdle rate of 0.08. If you calculate this, you're going to get an amount of 2.4%. Then for B, the soft hurdle rate, this one is easier. It's just going to be, once the return is exceeded of 14%, then carried interest, the soft hurdle rate is 10%, and this has been exceeded with 14% here, which means the return is basically going to be the total return 14. So it's 0.2 times 14%, which is 2.8%. Then C, again, is a soft, which is also straightforward. It's going to be the carried interest 15%, 0.15 multiplied by the total return 0.8%. 18 or 18%, just doesn't make a difference. It's going to be 2.7%. So what you see is for the soft, it's easier. It's just the total fund return multiplied by the carried interest. And you will see that if it's 18%, it has exceeded 8. If it's 10%, it is exceeded. If it's 14%, it has exceeded 10. And then with the hard rate, remember, you have to subtract the amount that they got minus, because it's over and above the hurdle rate. It must be above the hurdle rate, your R minus the RH multiplied by the carried interest. Okay, so the highest is this one, B. I'm sure you can see that. The LPs of a venture capital fund with high expected volatility of exit of portfolios following 100% distribution are most likely to seek which one of the following? So they will seek a clawback provision. Remember this, because there's a high expected exit, 100% are most likely to seek which one? So there's high expected volatility of exit. Anything can happen. They might lose their money. So the clawback is that the money goes back to the LPs if the GPs underperform in subsequent years. This high watermark is usually used by hedge funds. So this is common for hedge funds. And one of the most important things that we spoke about is that these assets are then marked to market. Okay. So the high watermark is common in hedge funds that mark to market transactions for purposes of calculating fees, but are less likely to be observed in other private markets. They are very likely in hedge funds and not other private market assets. Okay, so private investment selection and value creation, which I said is going to be the last section of this. So you can pause this video and then come back and then we continue. And then, but I want to get through this now, and then yeah, we'll wrap up with some another section, due diligence, and then some more questions for you guys to practice. But let's complete this section. Private investment selection and value creation. So they want to prioritize private investment targets, and this extends beyond security selection, like for public fund managers who select securities based on their price. If they are overpriced, then they want to sell that. If they are underpriced, they want to buy that asset. In this instance, the active GP engagement, they require investment lifecycle management, identification of undervalued companies and assets, narrowing investment targets to those where controlling stake or significant minority positions can drive value creation. Remember, we said for private market, GPs want to buy private assets in which they have either minority control or significant control of that particular asset, and then they can create value within that asset. So these are the important things: the life cycle, the identification of undervalued assets, and ability to control a stake of that company. So the value creation potential over the life cycle is shown on the next slide. Yeah, I tried to make this slide, but it might not be visible. I'll paste the slide so you can see. If you zoom in, maybe you'll be able to see this, but I will explain this quickly. In the startup, which is the first phase, remember the cash flows follow a J curve. If you remember, it starts off with a negative, and then it's going to be a positive in later stages. So it's negative. The cash flows are negative initially, but then they become positive as the companies grow and become mature. So with startup companies, they have very high growth potential, and they seek to disrupt established industries with new products. Some of the key properties of these companies are that the founders, they have their patents, they have intellectual property, they have business ideas, right? And they want an investor to be looking for people that have a successful record of creating new companies. The value that comes up from startup companies are non-financial milestones. So this is important. The milestones are non-financial. The new product prototypes, in testing, validating a business concept, in setting up a go-to-market strategy. Okay, so these are the value creation in the startup. Non-financial milestones, new product prototypes, testing, validating a business concept, setting up a go-to-market strategy. The the growth stage of firms. So these, they target existing products, customer base, and business models. These are established companies, right? And then they want to look at well-managed firms and optimize on that. And they want the demand for that product to be high or increasing. There might be capacity constraints which might hinder future profitability. So there is need for capital investments to create the necessary scale to meet the capacity and realize the opportunities for growth. In the mature industries, these are industries that have been in the game for some time, and they target things like buyout equity investors, and they want to unlock growth and profitability potential. These are usually large firms with strong market share. They have consistent cash flow, and they are in some less competitive industries because of regulation or other barriers to enter the market. There are large performance or management issues. So the value creation process is going to include the use of leverage. So you use a lot of debt to acquire the companies, transforming the company in terms of its operation, to add management talent, increase efficiency, new business strategies, and so forth, so that you get a higher market value upon exit and you make money from that. So these are different stages at which they can actually invest in the life cycle. And the sources of value creation for private equity in particular, they can be strategic when you sell non-core business divisions or you pursue strategic growth initiatives, products, clients, regions, channels, etc., or you acquire new lines of business. The value creation will also come from operations. You target sales and revenue growth, you maximize your operational efficiency, you increase labor productivity, or you optimize on the use of technology, research, development, and capital expenditures. All right. So when you target sales and revenue growth, this might actually be quite profitable in terms of your buyouts. Okay. And then another source of value creation of private equity is financial. You improve on the balance sheets, you improve on optimize working capital and long-term financing sources, manage cash flow, receivables, assets. So this is something that could work quite well for retail companies. And then organizational, you replace or rebuild the management team, you restructure the organization to meet new objectives, you establish new and streamline existing processes. So you want to make it more efficient from an organizational perspective. So these are the four main strategies that are used to increase value in private equity: strategic, operational, financial, and organizational. All right. And then finally, let's compare real estate and infrastructure. Just quickly go through this. This is something that goes without saying. You should know this, but it's straightforward. In terms of value drivers, real estate, there's current and future economic use, income from core properties, open-end diversified core equity funds. And these operate like publicly traded REITs, your real estate investment trusts. Those are the value drivers for real estate. For infrastructure, these are long-term contracts, and the long-term contracts are known as concession agreements, regulations that govern their economic use and income generation potential. Project types, real estate, they can be opportunistic. These ones run down and high. They require high initial costs, like your startups. And the core properties, they give stable cash flows. Infrastructure, you have your build, operate, and transfer. So the build, operate, transfer, the way they work is that they build these buildings, they operate them, and then they transfer them. When the ownership is transferred, it's transferred to the guarantor at a zero terminal value. So the transfer for build, operate, transfer projects is done at a zero terminal value. This is zero terminal value. The focus is on essential services with demand that is inelastic. For instance, you build infrastructure on a busy toll road. What then happens is that if you want to move from point A to point B, I remember there's a time when the government of South Africa wanted to put toll roads between Pretoria and Johannesburg. These are two major cities, like the administrative capital is Pretoria and the commercial capital is Johannesburg. So people move between Joburg and Pretoria every day. They put toll roads there. The demand for the use of this road is inelastic. Inelastic means people are going to demand something regardless of the price, right? You remember it's elasticity. We talk about the sensitivity of demand to changes in price, ceteris paribus alone. So in this instance, demand is inelastic. Even if they put a high toll fee, people still need to travel. But there were so huge protests because people didn't want to pay these toll roads, and the government ended up cancelling it. That's one challenge that you face after putting up millions of infrastructure and people strike, demonstrate, then you lose out. The problem. But it will focus on such infrastructure where the demand is inelastic. In terms of the key factors for investment, location and project suitability is important for real estate. You want locations where crime is low and overall there are high positive externalities. Supply and development, local, regional, and global economy. In terms of infrastructure, the economic use, industry, business model, government incentives, e.g., renewable energy uses. Okay. For infrastructure, it can be attractive, opportunistic, essential services with relatively inelastic demand, less exposure to market cyclicality or economic shocks, and the ability to increase user fees along with inflation. For instance, you want to invest in energy infrastructure. That could also be a key factor to invest. In terms of value creation, for real estate, value is created if completion is on time, full occupancy, you have enough people tenants, and stable income. And then for infrastructure, the value creation is when you maximize efficiency under fixed contracts and you capitalize on commercial opportunities. The risks in real estate are associated with delays, economic changes, and technological disruptions. Okay, like for example, COVID-19, now people need to work online. But infrastructure also is illiquidity constraints and sunk costs, like the setting up of all those toll roads. And the next thing is you've put infrastructure to collect toll fees. People demonstrate, you lose so much money from the infrastructure that you've set up, which used quite extensive technology. And also asset transfer with no exit value. Remember, when you look at the build, operate, transfer, what happens is that it's transferred to the guarantor at zero terminal value. Okay. All right. We are done. You can pause and go through these questions. Then I'll give you the answers in a second. If you paused, welcome back. The question said, the first one, a primary value creation focus of private equity managers investing in companies in startup phase of the company life cycle is most likely to be. If you read through the answers, answer A makes the most sense, because we are looking at investing in companies at startup phase. And we said for startup, the main idea is to achieve a achievement of non-financial outcomes. Startup, they are not looking at money, but they are looking at validating a business concept. For instance, new project prototypes, new procedures of doing something, and so forth. Your go-to-market strategies, etc. So the achievement of company revenue growth greater than growth in the company's total addressable market. This is the growth phase. And achievement of company efficiency gains. This is actually the mature phase. Achievement of efficiency is on the mature phase. Growth is on the growth phase. Straightforward. Which of the following is unique valuation component of the build, operate, transfer project model that is typically not used to value other categories of private asset? So this also is quite straightforward. The answer is B. Build, operate, transfer projects have zero terminal value at the end of the agreement. So this is important to note. There's zero terminal value at the okay. Build, operate, transfer projects rely significantly. Build, operate, transfer projects rely on a significant amount of debt. This is also true, but it's not unique to build, operate, transfer. It's true they rely on significant amount of debt, but that is the issue with most private investments, private market investments. So it's not unique. Okay. It applies to private real estate. It applies to private buyout equities. They are highly leveraged. All right. And then build, operate, and transfer project model projects a value based on the economic use of the asset. This is also true, but it's not unique to private market investments. Okay, it's not unique to private market investments. It's also real estate has the same thing. We spoke about this, that the economic use is important in terms of real estate. The last question: which of the following is likely not a critical value creation strategy of a private real estate partner? If you read the question, answers, C is correct. Ability to anticipate changing economic conditions in the development plans. So this is not a critical value creation for the real estate general partner. The other ones are very important. We said the schedule completion is quite important, and the ability to ensure that the buildings are occupied, new tenants, is also important. These two are critical. The last one, the ability to anticipate changing economic conditions in development plans, this is not critical. All right, so yeah, this was quite long. I don't know if you managed to go through all of this. I also got tired at some point. Work on making these videos shorter, but if you manage to stick it out until the end, well done. I'll see you guys in the next session where we wrap up this section on general partner investor perspective in the investment process by looking at due diligence. Until I see you guys again, Mr. Mash is out. Enjoy economics. Cheers.